the next session is on the all-important subject of money. So everybody needs to know about money. So in the session, we're going to be led by Andrew Harper, who's our friend and partner at Sidley, and he'll introduce the panel. Okay.
Excellent. Hey, everyone. I'm Andrew. I'm a partner at Sidley. I represent startups and venture capital funds. I represent startups through all stages of their life cycle, from day one all the way through exit, whether that be IPO, M&A, or SPAC, or what have you, and everything in between. I also spend a fair amount of time representing investors and corporate VCs investing in startups. We have a great panel. We're going to talk about financing, developments, and exit trends. And we've got a really good cross-section of people in the market to talk about, to give different perspectives. So I'll leave it to you to introduce yourselves. We've got a financial investor, VC, a banker, and Sam from BMWi Ventures to represent a corporate perspective. So, and you want to go ahead and introduce yourselves?
Happy to kick it off. I'll try to keep it somewhat brief. Dan Ratliff is my name. I'm a principal at Fontanellis Partners. We're a thematically focused venture fund investing in mobility technologies. We view mobility very broadly, so it's really any technology that impacts the movement of people or goods. And so everything from automotive to supply chain to enabling technologies like cybersecurity, additive manufacturing, and everything in between. Mostly focused, or I'd say historically, we've invested the bulk of our capital on the enterprise side. And also in the software side, maybe 70% or so. More recently, we've been making more investments in some of the more deep tech sensors and hardware and manufacturing technologies that have major applications in mobility and supply chain and beyond. We're an early stage fund investing primarily seed through Series B with a little bit of flexibility beyond that. But we just raised a new $104 million fund, and we've been pretty active in deploying that for the past few months since closing that out. And yeah.
Excellent.
Yeah. I'm Jason Wortendyke. I'm managing director at Citi. I lead what we call globally our diversified industrials business, and also lead our Chicago office and Midwest region. My relevance here, because I'm a Chicagoan, I feel a little out of water here in the Bay Area, is that I've also spent a good deal of my personal time within our diversified industrials business in the mobility sector. So focusing on helping companies with late stage venture, where we do run private placement processes, but predominantly into the IPO, as well as corporate sales, mergers, acquisitions.
I'm Sam Huang from BMWi Ventures. We're the corporate venture fund from BMW. So what we do is invest in seed to Series B stage companies in four main areas, which include, of course, automotive/transportation, manufacturing, supply chain, and sustainability. And in terms of how we work with corporate, we're kind of, there's a Chinese wall between us, but of course our value add is bringing the potential of collaboration, whether that's joint development, being a customer, knowledge sharing, or some form of other collaboration. That's kind of our secret sauce. We're financial investors at heart. We just launched our second fund. First fund's closed up, and now we're rapidly deploying capital and excited to be here.
Excellent, thanks. So the timing of this talk is perfect. The last time we convened last year, we were in the eye of the SPAC storm, and it was going gangbusters. Things have changed a little bit since then, just a little bit. What's changed in the SPAC market?
Yeah, I'll start. I think we're in a different eye of the storm of the SPAC market, I'll say. It's just the bad one. We were in the very front end last time when Howard invited us out to talk about why SPACs were a really great use of capital to help early stage companies get public earlier and really form substantial amounts of capital and provide public equity investors, access to those venture returns. Unfortunately, what's happened is the market, went through a classic sort of very rapid boom and bust. When we sat here last year, I think we were saying, wow, we had about 14 billion of SPAC issuance in 2019, about 80 billion in 2020, and that's probably a peak. And we're going to see it go down from here. In the first quarter of 2021, of course, we raised about 125 billion of capital in the first quarter alone, and year to date, it's 155 billion. And what that meant was people got pretty excited about a lot of early stage concepts. And while some of those businesses were very credible, others may not have been perfectly diligenced. And we're now seeing the aftermath of that in the public markets. There are a lot of people saying, wow, this was just a product that shouldn't exist. I don't think that's the case. We actually believe, and we still are issuing SPACs for probably higher quality, more well-diligenced sponsors. And the deals that are being successful are ones where the sponsors are adding real value and helping bring earlier stage companies to market. But the volumes got a bit out of hand. There was a supply-demand imbalance. And I think we will see that return to normal probably next year. But you have to remember, with all that capital being raised, there's still 155 billion of SPAC capital outstanding that doesn't have an announced deal. So people looking to find companies like some of the companies in this room and bring them public. And I've spent a lot of time getting deals closed over the last 6 months. And what we've seen is SPAC redemptions are quite high. So when someone comes to you and approaches your company, it's still an interesting thing to potentially consider. But do they have a backstop? How certain is their capital? Are they giving you a reasonable valuation? Are you going to go through a long process to find out the money's not there at the end? And so those are the things we're dealing with today. But I don't think SPACs are dead. But you have to be very, very cautious about who you get in bed with and if it's the right stage and right type of financing for your company.
Yeah, definitely. And what are you seeing in the auto and mobility space in particular? I know we've seen some backlash from SPACs like Lordstown and Canoe and what have you, but clearly there's still some good deals getting done and good companies coming to market.
Yeah, there are. I think the three things I'd say that we're hearing more from the investor side when we're bringing out deals to either raise pipes to complement the SPAC, or in some cases where we've decided to announce deals such as Tritium, the DC fast charging equipment company, without a pipe. Because we had conviction around the valuation and conviction around the business model, is what diligence was really done. Is the management team ready to run a public company? Which I think, honestly, that was one of the issues. People said, wow, there's this huge pile of money here. I have to take it. But being a public company CEO is a little different than being a founder CEO and early stage venture backed. And also, is the depth of the management team there? Not just is the visionary founder a good public company CEO, but does he have a CFO? Does he have a CAO? Does he have somebody who's going to be able to do business development and IR and general counsels are often lacking when we meet some of the SPAC names. And then finally, people are no longer really interested in 2027 revenue. Right? People want to see businesses that have a business model that isn't fully subject to a future wish or dream. You have to prove out that even if you're a nascent stage, the business model is perfected to such a stature that the capital will allow you to grow very rapidly. So it's not a pure technology risk or a believe in a TAM that's not yet fully vetted by the market.
Excellent. Dan, Sam, how do you think about this trend? Does it impact your investment theses that you either think about this as still a viable exit option or not, or what are you telling your portfolio companies when they're thinking about SPACs?
Yeah, I think we advise them to be very thoughtful in consideration of it. It's one tool of many to raise capital and to get liquidity. And I don't think it's necessarily an exit event, nor is it just a liquidity event, but it could be somewhat of a hybrid. So as we have companies that are considering it, it's a unique source of capital. It brings them out into the public markets. They're more known if their business model is such that that it's almost like a marketing tool in some respect, being out in the public markets. And so if they've got the team, which is super critical, that can be a public company quality team, and they've got sight into building revenues and establish themselves as a public company, even through like a traditional IPO process. It's one mechanism that maybe is just easier to get done and can bring that cash under their books that they can go, then just focus on building the business and executing. But I think that's how we look at it. It's not, don't look at it as just an exit event because there's a lot of this volatility in the market. Look at it as a way to get the capital you need to accomplish the goals you want, and know that you're going to have a lot more responsibility once you take that decision on and become a public company with quarterly earnings and all these other aspects. So I think we're going to see, there's that kind of crazy period, this boom and bust. I think it's going to set the bar higher for what companies are able to complete SPACs in the future. And I think it'll be a good tool for a certain profile of companies to consider. But obviously SPACs have been around for a lot longer than the past 12 months. They've just become insanely popular of late. And I think that'll peel back a little bit, and then it'll be just another good option that's a little bit more known and understood because because of this boom and bust. Everyone understands like that is now an option. Whereas, go back 2 years ago, companies probably weren't thinking twice about it. They were just, M&A or build the company or try to get to that IPO.
Yeah. So now I think we're seeing more companies without a SPAC so readily available. They're coming back to the private markets for larger rounds and later stage rounds. What are you seeing in the market right now? How is that impacting valuations at earlier stages too? And what are you seeing in the market right now?
I would say I just want to touch kind of like on the broader SPAC question, which was, a lot of the points that you brought up about the SPAC market changing is kind of anecdotally evidenced through our own portfolio, where last year, a year and a half, we had like 5 SPAC IPOs. Like, right, that just doesn't really happen. We also had an IPO, but 5 doesn't really make sense in the broader scheme of things in terms of like statistical probability of things actually happening. It made no freaking sense. And then now what we're seeing is that we had some portfolio companies that were seeking to go SPAC. I would say, some portfolio companies, they really deserve to go SPAC, and some, with any sort of portfolio, is questionable. And we're also seeing in the process that, questionable companies that are seeking to go SPAC, when they were either had a letter of intent or even they've, had come to the final stages of de-SPACing, some have unwound. Some of the, SPAC sponsors have, determined that they wanted to get out. And so that is unwinding a lot of the SPACs. And I think it's just putting a dampener on what I would consider irrational exuberance in the market, just driving all of the, all of us towards exits, all of us towards higher valuations and so forth. So just, I guess when I look at a portfolio company or when I talk to a company who says that they're going to go SPAC IPO, I always discount that because I just find it a silly way to think about how you want to exit, because you can't guarantee that. But the question that you asked just now, Andrew, was, what's happening? The result is SPAC. Well, valuations are freaking high. That's due to a number of things that I think we'll touch on later. But it's just, I think the market is crazy right now, and we're just seeing signs of irrational exuberance that will end in a terrible, chaotic sandstorm.
Yeah, I would say also.
So maybe you should all do SPACs now.
Yeah. Get them done while you can. But realistically, when we see valuations are going up, round sizes are swelling, deals are getting done faster. I don't think that's necessarily all a result of what happened with SPACs, but I do think there's like a 6-month period where every pitch deck would say we're raising this $20 million seed round for the next 6 months, and then we're going to SPAC instead of a Series A. And you're like, this is absurd. Like, this is not how it works. But they were seeing successful SPACs de-SPAC with seemingly no more progress towards their product or commercialization or things like that. So I think everyone's that's pulled back a little bit, and you're not seeing that as much anymore. And you can at least say like, all right, let's go back to how we built venture-backed businesses 2 years ago, and let's get back on that cadence of raising capital, hitting proof points, showing metrics, and then raising more capital to drive growth. And let's not worry about getting this race to the public markets. And I think there's, at least you're seeing that the entrepreneurs are recognizing that. They're probably getting a lot of that feedback that these valuations and these round sizes are not going to be sustainable just on the fact that you're going to go SPAC. You need to show me something else. And Sam alluded to, there's other factors at play here. There's other new capital coming in, other things driving up some of these dynamics. But I think at least the SPAC conversation is cooled enough that it's less the lead of the story.
Right. And I think it's definitely multifaceted and confluence of a bunch of things, right? So it's more capital from mega funds and huge funds and traditionally financial investors, more CVC funds popping up every day. What are you seeing? What other developments are you seeing in private rounds?
Just to start, I think it's a very interesting point that I think the SPAC craze and peak SPAC sort of February 2021. There was a lot of crowding out of traditional investments. So I think venture capital was crowded out, private equity was crowded out, even some of the pre-IPO investors who I don't really consider venture as much, like the Fidelities of the world who do pre-IPO rounds were crowded out. And I think while that was going on, everybody went back and said, maybe we need to look at things a different way. So from my perspective on the sort of advisory side, when I talk to newer companies or companies that are going through maybe their initial institutional fundraise, there's a lot more capital out there in different forms than there was. And you all should talk about your forms of capital, certainly. But I think I've heard from all of the major big cap private equity firms that maybe now they'll do growth rounds. They'll do a late stage growth round minority, which you would never hear before from a Bain, a KKR. These folks were all control, and you had to be cash flow. You needed to be a leverage play. And so there's a new tool in the tool chest, and as well as all the big private capital sustainability funds. So a lot of folks in this room are very keyed to ESG thematics. And you have many multi-billion-dollar funds, where there's TPG's $7 billion Rise Fund, new climate change focus, Beyond Net Zero, backed by GA, I think is going to close on $4 billion. It's a lot more bigger sort of pre-IPO startup capital.
Absolutely.
And also, I just wanted to touch on another craze or fervor that has happened, which is the Tiger Global effect, which, Tiger Global is a big hedge fund. What are they, like $100 billion now? So what they're coming in and is driving up, they're putting in and competing with all these early stage investors. They're putting in a valuation that is absolutely crazy. One of my friend's companies got a valuation of 80x the revenue for a SaaS company. One of my portfolio companies got another term sheet from another hedge fund type, that was 200x the revenue, which is kind of unheard of. But it actually makes sense from these hedge funds or these bigger players coming in and driving up valuations, because to them, venture is a power law game where you expect 9 of your 10 portfolio companies to do okay, but you'll have such a high winning portfolio company that is the 10th company that will draw your returns up and to the right, returning your fund 5x, right? And so that's literally what these hedge funds are doing. It's driving up valuations. It's also pouring in unprecedented amounts of capital into the market. And so all of the VC ecosystem, the ones that are kind of growth equity or growth stage or later stage, they're kind of screwed. But so everyone's trying to go earlier to kind of combat this Tiger Global effect, this general hedge fund effect of these big players coming in and driving up valuations.
Right. And it's definitely having a trickle down effect. Even at the early stages, valuations are absurd. And so you've got investors coming in like Tiger and others now. They'll come in, they'll be extremely fast. We'll close deals in 2 weeks, or if not less. They'll do very little diligence. They may not even take a board seat. How do you compete with that? And what is...
I think a little bit of is, well, one, I would say, I think that's a little bit of a misconception in Tiger. They've got this team of investment bankers that are used to working 100-hour weeks, and that they don't care to just grind through this due diligence process. And I think they go pretty deep. They move incredibly fast, but they, from little anecdotes I've heard, they do a very comprehensive diligence process in a lot of their investments they're making. They're just able to get to that determination quicker because they're just throwing resources, and they know it doesn't matter if we spend all this time and energy. If we can get there quickly and speed wins us a deal, that's helpful. And then they obviously have the capital to throw behind it as well. And these investors like them, these hedge funds that are coming in even to the seed or Series A stage, they're doing so with a little bit of, some of them are LPs in venture funds and saying, who's your winner? If you had to pick one company, who is that? And they want to go and just back that company and throw cash into them, or they want to, just even if they're not LPs, they're saying to venture investors, give me a lead on what companies you think is going to be your standout. And they have a little bit of that insider information. But from a traditional, venture investor, how are we reacting? And I think you just have to be more flexible. 5 years ago, we, from our fund size operating of $100 million fund, we were making 3 or 4 investments a year at Series A, Series B deals, and we could write a $3 to $5 million check that might be in some Series A rounds a lead or a co-lead. That doesn't happen anymore. You're not finding rounds that are small enough for that to make sense. So being more flexible, just wanting to be part of the best companies, no matter what that looks like. It could be a smaller check, a follow-on. You don't need to demand we've kind of relaxed requirements to have a certain ownership threshold, or to have a board seat, or to certain companies we think we can add value in different ways, or we want some of these things. But I think just being as flexible as possible, being able to move quickly, though, is certainly critical. and working with, other investors, collaborating, just finding folks that you want to work with and saying, and getting deals done together where you might have a lead on something and you can bring people in and you can all just move fast together. And not that you're competing necessarily against, the Tigers of the world, but to a certain extent, they're coming into our territory. And so we need to kind of, work together to make sure that we can still have a seat at the table.
Can we throw you a question, Andrew? Because so Andrew
No,
is
that's
actually our
not allowed.
attorney.
Not
So, because I'm guessing that you probably experienced just an uptick in work too, right? That's just uptick in deals.
Yeah, it's been relentless for quite a while now, and as quickly as you want to move, you want your lawyers to move just as quickly or faster. So no, it's been absolutely insane, and the market has just been relentless. It's definitely an exciting time. I mean, one thing that I think I've seen is more competition, more market entrants, more. I mean, CVCs now, one development that I've seen just over the past, 18 months to 2 years is corporates are less restrictive on their terms. You're seeing fewer ROFRs, rights of first refusal or notice to buy companies, less control terms, and playing nicely with one another more than they might have historically. So you're seeing multiple CVCs invest in the same companies. You're seeing more financial investors who are more comfortable with things like hardware than they used to be, which is directly impacting auto and mobility and things we're talking about here. So I think it's the perfect storm for a frenzy, and hopefully not a chaotic sandstorm that's going to end.
Yeah, we'll have to take
terribly.
bets on whether it's a chaotic sandstorm or irrational. But on the CVC corporate venture capital point, I will say, 5 years ago, I could probably name 3 clients of mine that had venture capital arms. And today, I probably can't name anybody who has bigger than a $5 billion market cap who doesn't. So every sector, every type of company, whether it's a big diversified conglomerate like ITW, Dover, Honeywell, we have folks here obviously representing that, to machinery company, John Deere, Caterpillar, right? Everyone's doing this, and so they view it just as another way to look at early stage M&A targets to try to get faster to market, and it sort of folds into what's going on in the M&A markets, which have been equally exuberant. We've got 4.7 trillion of M&A booked year to date, which is the highest year by far, and we're not even done with the year. We'll have a bit in the coming quarter, still before year end. But we also have an all-time record valuation in M&A markets, around 15.5 times EBITDA is the average multiples. That includes restructurings and low value deals, also includes software deals, but that's by a factor of 3, the highest multiple. Sorry, by 3 points, the highest multiple we've ever had. And I think everyone's looking around saying, how can we get access to companies like this that might change our business model going forward earlier? And that's corporate venture capital.
Can I speak on one point on CVC, because I'm the CVC here, so I thought I should at least announce myself as that. So I would say, despite I don't know what other CVCs are doing because I only see the mirror of myself. But for our second fund, which we just started, we're actually not doing what a lot of the CVCs sound like they're doing. We're actually making sure that we remain disciplined with valuations, that we get meaningful ownership, that we take a board seat, that we get, pro rata rights, all of the, the rights of control that traditionally VC investors would fight for. And I think that's just because, we view that as necessary to getting the returns that we need. But, we don't represent all CVCs, and we're a little bit more on the financial side. So that's why I would say that we're a little different. That said, I think CVCs can get into deals because of the brand, because of the potential to work with the corporation. And so even though, we won't come in with the highest valuation, you'll get that potential to work with us in the future. And that's kind of the value add that we add. So I would say, I understand, totally get the CVCs things, but I would say there's some that are also just holding back and maintaining discipline because it's a strategic thing in terms of, getting the financial returns.
Well,
So sorry to interrupt. Howard's signing something at me.
I have a question or a comment.
Okay,
on-
questions?
Yeah, so on that, a comment on, so I'd like to just bring the conversation back to the earlier discussion about money flows, valuations, and trends in the market, because I think it'd be useful to tease out for this market what's relevant for markets as a whole, which, we know SPACs are big across all sectors practically, or were. Markets are overvalued in many, many different sectors. I mean, SaaS deals are overvalued. Many, many deals are overvalued. But we're now in an automobility tech event. And this industry has its own specific circumstances, right? We're talking about a complete disruption of the automobile industry right now. That certainly must have impacts on valuations, on the motivations of CVCs, on where the money is being put to play. We're also talking about a huge disruption in general with respect to climate change, right? So there's all these money flows that are being motivated by climate change investment goals, right? So I think it'd be useful to separate out which of those things are unique to this discussion for automobility tech and which are sort of the broader contexts that are causing these money flows. So for example, even if the SPACs are sort of are receding, right? The valuations, my impression is they're still way up there, right? Mm-hmm. And are they way up there, especially in particular with respect to the automobility market? Because, for example, you got these strategics out there that are really stretching hard to figure out what they're going to do next and how they're going to survive, right? So, and maybe there are also people putting lots of money in play so that they can actually figure out how to get make their climate change commitments true. Right? So maybe you can speak to those points.
Yeah, maybe just to try to frame what you just said, Howard, because I agree with it. I think everything that's been said here, I think, is relevant to auto mobility and mobility technology. And maybe one way that I've heard a lot about it was when I'm in corporate boardrooms in the automotive area. People aren't looking anymore and saying, do we acquire this company or make an investment in this company because over 3 or 5 years, it's got a great ROIC profile, return on invested capital profile. They're saying, and they're being asked by their board, if we don't acquire this company in 5 years, can we meet our business plan? Right. And I think that's a very different tone. Right. Then the disruption is palpable, and it's backstopped, even if SPACs go away, by some of these other big forces in the market, climate change funds, bigger VCs.
Right. So that's exactly my point. Is that this is maybe a survival issue for.
It's existential for many companies. Yes.
Right. Yeah, I think that's relevant on the M&A side, especially. But when you go back to just venture rounds, I think to look at the role that maybe CVCs or corporate investors have on valuations, I don't think it's that much, because I think the ones that are like leading rounds are operating more as financial investors. There's some corporates that are out there that maybe are less price sensitive, but they're going to say, I'm not going to write a term sheet. I want to be in a round. So they might not be price sensitive, but they're not setting the terms that raises that round up. Maybe that gives the company a little bit more negotiating leverage with whoever is leading. But there are the firms that operate like BMW does that are very much like a more traditional independent venture firm. They pay attention to all the same stuff. And so I don't think that's what's driving it up. But I think maybe what you're seeing is the quality of companies and the quality of entrepreneurs. And the overall market's obviously lifted up, but in mobility specifically, the success of this kind of first wave of companies, whether it's the Teslas or the Ubers and Lyfts or all these different models that have to do with mobility, you're having these first-time entrepreneurs that have made money and have been part of these high-growth teams that are now going on to start second companies or third companies, and they've got experience taking companies public, and all this is kind of coming together to build these like powerful teams that you weren't seeing 5 years ago and 10 years ago. You were seeing really impressive people, but now that mobility has a spotlight, now that everything that you've seen in the SPAC craze and some of these major exits in mobility, even entrepreneurs that had no prior background in mobility but have maybe been really successful, multiple exit entrepreneurs, they're saying this is a massive multi-trillion-dollar opportunity. I'm going to go build a business there. I've thought about doing something in, I don't know, fintech, but I want to go do something in mobility because it's showing that there's just this massive market. And so I think that has just as much of an impact on things like valuation and attracting capital. That you're getting, really experienced, big name, high quality entrepreneurs that are then commanding, and deservedly so in many cases, the valuations that they're getting because they've got a track record.
Definitely. Yeah, and I think you did, and like we talked about before, I think a lot of what we said is relatable to auto and mobility. And so all the new market participants coming in, investors being more comfortable with hardware. I mean, we saw it today, 80% of the startups here today have a hardware solution, and financial investors who used to be very uncomfortable getting into this space are happy to come in. So it's really everything.
We're getting
Any last questions?
Questions?
One more question if there's any. Yeah.
So what do you see of, there's this opening of companies going IPO in London Stock Exchange. What's that all about? Right? I mean, Alphabet is going IPO at 4 billion, Bonny is now, obviously Harper has all this thing. But do you see a trend toward, more of a London Stock Exchange IPOs, or is that a one-off?
I would, in my view,
the question was, do we see a trend more toward London Stock Exchange listings? Are you getting, I think your question is outsized valuation there for whatever reason. I would say we haven't seen that. When we advise clients on primary regular way IPOs, it's really about which market understands the business model, where the best comps are. And if it's new and disruptive, the US is usually the high value payer. So US listings are still where we advise companies. We took several Chinese companies public last year before some of the challenges we're having now with the regulator there. And we always list first in the US and then dual list back in Hong Kong or in China proper, because the US investors understand and comp to disruptive tech better. London has a few areas where there's specialties. Let's say fish farming, right? And some of the ag related tech happens to be, because it's Nordic and London, people get better valuations there. But for mobility tech, the US listing is generally the premium listing.
yeah, I would say there's definitely been more interest and more development, more new companies popping up internationally, and US investors happy to invest in more international companies, but there's still the vast majority of the time setting up as Delaware C Corps and ultimately trying to come to the US to access investors and markets. So.
Okay.
All right.
Thank you.
Thank you very much.
Thank you.
Thanks, everyone.